we've talked a lot about silver and how the open interest in silver had declined from 184,000 contracts in June to 154,000 in September. This means that there was covering in contracts. That means that the open interest was declining. Yet the price continued to rise above $40 in the face of a declining open interest. Declining open interest, meaning less people involved or speculating, and rising price, in theory, only happens in a bear squeeze, where the shorts are covering because they're afraid. And now I would argue it's rising because the long speculators realize that metals are in a bull market. You know, you would think by now people would wake up to this, especially since gold prices are up 43% this year to date. This is putting them on track for the best annual performance in 46 years. You would think that people would start to wake up to this. Unfortunately, they're always late to the party, i.e. the little man rule. It's the big money who is there right now, and it's the big money that is moving in this direction. I want to talk a little bit about, you know, I try and touch upon the BRICS a little bit each time. Sometimes it's hard because sometimes the information's hard to find, or it just isn't really earth-shattering. This is one of these deals that really isn't earth-shattering, but I think people should pay attention to what they're doing. So, you know, I think that the U.S. is foolish in the way that they have stood up against the BRICS countries with tariffs. And soybeans, China used to be the biggest purchaser of soybeans from U.S. farmers. And you look at the Chinese import numbers for soybeans in August, they were at historically high levels, like the most ever. But the majority of these purchases are now coming from Brazil and other South American growers. And over 12 million tons of soybeans came into China in August. It's the second highest monthly total ever. And almost all of it, 11 million tons or more, about 85 to 90% of all of the soybeans came from Brazil. And now China has logged 4 consecutive months of record soybean imports. And this is, again, I think it's because of supply uncertainty with the United States, because of the trade war. Okay, well, so what, people would say. Well, this is, to me, a very big so what, not only for the American farmer, but also for the American government. Most of these global soybean trades were invoiced in U.S. dollars.
Across emerging markets, BRICS nations are actively building financial corridors that bypass the U.S. dollar. Brazil and China recently signed an agreement to establish a yuan-clearing system in Brazil, facilitating direct trade in local currencies rather than requiring conversion through New York clearinghouses. Projects like BRICS Pay seek to restructure international settlement messaging. These efforts represent intentional chipping away at dollar supremacy, and when paired with large commodity flows, they may recalibrate global currency power.
And now they're not. And so payments would have to clear through U.S. dollars through the international intermediary banks via the New York clearinghouses. This gave the dollar its dominance. This is what I've been talking about, you know, in our conversation today with Rick and Alistair earlier, talking about chipping away at dollar dominance through settling trade, whether it be the BRICS settling trade on government-to-government level like this, which I'm going to touch on in 1 second, or the BRICS Pay network, which will allow business-to-business, retail, business to the retail market also, to transact outside the dollar. Every one of these transactions is like an axe against like one of the giant redwood trees, you know, or the Shawshank Redemption, where Andy Dufresne used a little spoon or whatever to chip away at the wall over time. Chipping away at this new system, which isn't using dollars to settling over whether it be BRICS Pay network, whether it be over the BRICS Bridge network, Or they have something called a direct yuan clearing arrangement that they made in Brazil. Chinese did, and it allows the exporters, including the big soybean exporters, to invoice China directly in renminbi across the renminbi cross-border payment system, which settles in 7 seconds outside of SWIFT. And so this cuts out the U.S. dollar out of the loop completely.
Consider how China's soybean purchases shifted. Historically a top U.S. buyer, China now sources the majority from Brazil and uses yuan-linked settlement mechanisms. In August alone, over 12 million tons entered China, with 85 to 90% sourced from Brazil. The shift underscores how commodity trade is now being restructured to circumvent dollar dominance. What seems like agriculture is really financial engineering, altering invoice currency, settlement path, and finally reserve exposures.
So the Chinese importers pay in yuan, and the Brazilian sellers can either hold the yuan or convert them into gold or real if they want. But converting them into gold, and soon in all of these countries, whether it be the BRICS countries or the Belt Road, they'll have Shanghai vaults where metal is stored in all of these jurisdictions, all these multi-jurisdictions. And so you have the system that is being built little by little to cut out the dollar completely, not only in settlement, but also in reserve status. Instead of putting excess into treasuries, they will simply put them into gold because gold is backing this whole system. These are the things that a lot of the people who do not talk about, who push back against the BRICS and say that they are not as legitimate as perhaps we would think they are. And to me, that is a very silly mistake to make. And you can look at just the info coming out of the Bureau of Labor Statistics, and the BLS, take the L out, and they're just the BS. That's all they really are. But even using their own BS, the dollar is worth 82 cents of what it was worth in 2020. That's a 22% decline in the value of our money in 5 years, and it's probably worth a whole lot less. And, so I think when you talk about why these countries are doing it, not only is it the loss of value in the dollar, not only is it the weaponizing of the treasury market, but it is also the silliness of the imposing of these sanctions or these tariffs that are making all of these countries say, screw it. And then you look at, gold futures are past $3,800. And again, you're talking gold and silver moving up. Gold's up almost 9% in September alone. And silver's up 9 or 10% this month alone, up over 50% year to date. So you can see why all of these countries are accumulating gold and silver. You can see why the United States is.
With the weakening dollar and rising geopolitical friction, many nations are turning to gold and silver not just as investments, but as reserve assets. Instead of parking surpluses in U.S. treasuries, governments are accumulating hard assets. Silver, too, is benefiting. It has already doubled over 4 years and surged more than 45% in 2025. The pressure to suppress prices via derivatives or short positions is intense, but demand is proving resilient, even under heavy headwinds.
We've talked a lot about silver and how the open interest in silver had declined from 184,000 contracts in June to 154,000 in September. This means that there was covering in contracts. That means that the open interest was declining. Yet the price continued to rise above $40 in the face of a declining open interest. Declining open interest, meaning less people involved or speculating, and rising price, in theory, only happens in a bear squeeze, where the shorts are covering because they're afraid. And now I would argue it's rising because the long speculators realize that metals are in a bull market. And you got to wonder what the shorts are thinking right now as it continues to move higher. But you see all of the silver coming in, almost 11,000 tons of silver have come in this year. About 60% of global mine supply for 9 months have come into the United States. And so basically what you're seeing is, I think, a reawakening again of what silver has to offer. Now, if being on the short side of this has to be terrifying, as we're seeing now massive investment interest in there. Maybe this is why we're seeing such a huge short position in SLV. They're running out of ways to hold the price down. And in the face of rising short positions, silver and gold are still doing well. Of course, they're doing it in SLV and GLD, a little bit more opaque, instead of putting it right on the COMEX. But even still, you're beginning to see big money start to challenge the suppression of gold and silver. And I don't know, I think that it's not just gold and silver, it's platinum, which is up almost 65% this year. And so, yeah, you're seeing, again, what's China doing with platinum? They're importing platinum at a run rate of 58% of global mine supply. Again, it's not just gold and silver, it's everything. Precious metals, base metals, commodities like soybeans. They're doing everything they can, and they're paying for it and doing it in ways that are pushing back against the dollar. But to my point about the short positions, the short position in SLV exploded 67% higher, and gold almost 70% higher. This is aimed at keeping metals down. Now, normally such a barrage of these shorts would crush the price. It's textbook suppression. Flood the market with borrowed shares, push the chart flat, kill the momentum, kill the rising price. But the effort, this enormous effort to hold it down, is pale in comparison to the demand, which is even stronger. And I think that's very, very scary to these shorts. If gold and silver are holding this strong under record short pressure on SLD and GLD, what happens when that pressure fails? And I think it is failing right now. So yeah, I would expect to see much higher prices in gold and silver moving forward. I really do. And I don't know, I think it's just the beginning, Dunnigan.
While many believe there's ample metal supply, the reality is tighter than it looks. Inventory costs, insurance, transport, and capital constraints all erode efficiency. Many dealers and distributors are unable or unwilling to scale holdings. This friction means even a modest increase in demand can rapidly deplete available stock. Simultaneously, price premiums are widening, making spot delivery more expensive. In some markets, retail buyers are already triggered by rising costs and lagging stock, a signal that stress is creeping into the chain.
Demand is really strong right now. Supply, which has been really good for a while, is getting very tough. And why is that? It's because supply was so good that the dealers didn't re-up. And with the rising prices, the cost of carrying this stuff is very expensive. The cost of shipping it has become very expensive. The cost of insurance to ship it has become very expensive. Just the cost of holding a large inventory has become very expensive. You better have millions and millions and millions of dollars in order to run an inventory, or you have nothing. And so, I look at our inventory, which is, I'm not happy with it right now. It's gotten so low so fast. And this is one of the things I was concerned about. And I say this on your show all the time. Just like that, it changes. And the market does change. And it wasn't just the companies like ours that feel this. It goes all the way up to the primary distributors who, again, they were choking on product too for a while. Like you said, that was slow at the beginning of the year. And just like that, it's not. And there's lag time between getting new product in from around the globe. The U.S. Mint, who really is the model of inefficiency, can never keep up adequately. And this is with now just a glimmer of new demand, and maybe it's coming from higher levels because you're getting this advice coming from Morgan Stanley and Jefferies and Bank of America, these people are talking, the CIOs or Michael Hartnett's of the world aren't talking to Jane and Joe Sixpack. They're talking to their institutional clients, their big money clients who are paying huge money for Michael Hartnett's writings. And same thing with the chief investment officer of Morgan Stanley. That's not stuff for the public. You pay for that stuff. This is the stuff that's given to their big clients. These are the people who are making moves before the public. The little man is still sitting in the Mag 7. The little man is still sitting in traditional assets that are not really doing or set up to do as well if things continue as the insiders are selling and the public is all in.
Forecasts remain predominantly bullish. JP Morgan projects gold averaging $3,675 by late 2025, with a push toward $4,000 in mid-2026. Meanwhile, HSBC expectations for silver have been revised upward, citing surging safe haven demand. If institutional allocation to precious metals rises beyond fractions of a percent, say toward 5 or even 20%, the liquidity disruption would be profound. The consequence, soaring premiums, delivery delays, and a more brittle metals market. And ultimately, a quieter revolution in how the world values money itself.
It's something that concerns me, honestly. And you've had me on your show here now talking about this really since 2024, where it's been slower than we would expect in an environment that shouldn't really, if you look at the facts, it shouldn't have been slow. But now people are waking up, not just the diehards that you and I have spoken to forever, the mainstream, just a little sliver of it, and probably the sophisticated side, the well-informed side, more so than the masses. But when you get, Dunlock and Bank of America and Morgan Stanley and Jefferies all saying the same thing, that's going to change. And now all of a sudden supply is becoming tougher to come by. Premiums are rising, and it doesn't take a whole lot of demand to wipe out inventories that have not really been aggressively added to. So we are in the process of doing that right now, but there is a lag time. And I would say to you, you haven't seen anything yet in terms of demand. If these guys are right and they're telling, putting the seed out there that, hey, this is about to explode, just a small uptick from the public will decimate availability in this industry overnight. And I don't say that lightly, I mean it sincerely. There's so much money out there, not to mention M2 spiking right now, money creation and just money in circulation that's been sitting on the sidelines in places like money markets and in treasuries, which are now being, maybe you shouldn't own so many, reevaluated by the people who sell them. I think that ultimately, I've said it before, I'll say it again, I'm not talking my book. I'm not trying to get you to run to the phone and make a phone call, but I'm dead serious. I really do believe that this market, before it's all said and done, will be looked at two ways by the people from the outside. Geez, prices got so high, I'm out. And the people on the inside, I want more, but it's so hard to get it. And the prices, the premiums are high and the delays are high, and used to be so easy to get it. I took that for granted, and now it's next to impossible. I believe that'll happen. I do. Because on our interview with Rick again this morning, he talked about the 0.5% allocation. What if it's 5%? Well, these guys are saying 20 and 25%. If it went to 25% or even 20%, well, that's a 40-fold increase. Just like that. Do you think that this industry can survive a 40-fold increase? Not a chance in Hades. And it would be lucky to survive 24 hours with a shift to that magnitude. And if they're saying 20 or 25, what do they really mean?